Just want to thank you very much all for being here today. I think we have a really fantastic guest and really interesting topic to dive in on today for a multitude of reasons. But today we're going to be speaking with Cameron Wu from the Arrive team. Arrive, for those who don't already know, is a really, really interesting platform that allows you to fractionally invest into the single family home asset class here in the United States, whether that's through individual properties or fund products as well. I think they've built a really phenomenal platform. I've been following their story for many years now. Big into investing in real estate myself, and feel it's a really important asset class for investors to have in their portfolio. Obviously, not investment advice, just saying I think it's a really nice piece to have in your portfolio and something that you should have exposure to. And Arrived is perhaps making this one of the most successful asset classes and one that, frankly, has become aspirational, unfortunately, for far too many because of the rising costs of housing here in the United States. So we're going to dive in on all things kind of the real estate markets, single family home property markets, whether that's on a national or regional basis. And then we're going to dive in on how you can utilize Arrive to start accessing this asset class. But to kick it off, I just want to start by having Cameron give a little bit of background on himself and tell us a little bit more about how Arrive works.
Yeah, thanks, Chris. I appreciate the opportunity to come on your webinar, and thanks for everyone who is in attendance. So a little bit about myself. I grew up in Texas in a smaller entrepreneurial real estate family. So ever since I was young, I have been in the real estate business. Some of my earliest memories are chasing dirt on job sites. So I grew up in Houston, and my family's originally from California. And we ended up there because after the oil embargo was lifted from from the Middle East into the U.S. in the 70s. Basically, Houston fell apart because Houston grew really quickly once the oil embargo was put in place. So you had really fast buildup of a lot of different areas. And then once the embargo was lifted, you basically had oil go from, $80 a barrel at the time in the 70s and 80s, which was a huge amount of money, back down to like $10 a barrel. So a lot of the real estate and the prices that were kind of locked in at the time of the construction, they just completely fell out. So there was a very regional crisis there. So we took whatever money that we had while we were in California, which was, peanuts for that market. And you could buy a lot in Houston. So that's how we really got started on our real estate investing journey from the time that I was a kid. So we did everything from buying rental homes, getting vacant land, buying distressed shopping centers. And you'd have to make the area cash flow because property taxes are really high in Texas because there's no state income tax. So that property tax pays for a lot of the infrastructure and government services. So we were always doing things like opening up a secondhand clothing store to utilize a building that we had bought, and then just kind of sitting on it, generate the cash flow to pay the taxes, and then would sell later. So that was a lot of my childhood, doing that kind of scrappy mom and pop type investing activity. And then as I grew up, then I went to school with the intention of becoming an attorney. So went through college, got a business degree, and then went through law school and got a JD MBA. But at the time I was graduating, this was around 2011 from grad school, and it was not a good market. So it was really tough to find any kind of legal opportunity. And like, as I was going through law school, I thought it was a really great education, but the career of being an attorney wasn't for me. So, I went to Las Vegas after I graduated school, and we were investing in real estate there. And we had the idea to start a lending company because we saw that the capital markets were really dry. Real estate markets were improving, and flippers didn't really have any source of capital. So we thought it was a great opportunity to make business purpose loans where it didn't require a lot of licensing, because you start getting into more licensing issues once you do owner occupancy mortgages. So your typical 30-year type of fixed mortgage broker type role. But when you're doing business purpose loans, the regulatory scheme kind of just evaporates, and it's more contractual and less regulated. So we could get into that type of lending quickly. And it was a really great business. So we did that for a couple of years, and then simultaneously, I found a position with American Homes for Rent. So they are I think the third largest today, single-family residential landlord in the country, and they've got about 60,000 homes in about 40 different markets. So I led their pricing operations, and then kind of graduated to more asset management, where we were managing the acquisitions, the dispositions, and the overall performance of the portfolio, and then helped build out the business intelligence department that served all different operating areas of that really large organization. So that's where I really cut my teeth on the institutional side of residential investing. And that hadn't really existed for single family residential until the 2010s decade. You can imagine that without the appropriate technology and the right buying opportunity, it'd be difficult for any large enterprise to manage 60,000 homes scattered throughout the country. The institutional model had always existed for commercial real estate and large multifamily because you didn't really need technology and you had scale on one city block to be able to build up a New York, apartment complex for 200 units and then manage it with a couple of on-site staff, right? So that business model existed for a long time and was mature, but really until that 2010s decade, you didn't have the right blend of that technology and game plan to be able to start that business. So it really took off in the 2010s, and I was right there in the center for that. And after about a 6.5 career at American Homes for Rent, then I had met the founders at Arrived. I thought it was a really great business model, and I had talked with them for about 6 months before I had joined. And once they had security offerings that the SEC had qualified, decided, all right, now's the time to join Arrived. And I felt a lot of conviction in joining the team because I thought it was a solution to a real problem. In that real estate has high barriers of you need enough capital, expertise, and time to even invest in real estate. It's called a passive activity, but I mean it's anything but passive. It's an extremely active and challenging asset class to invest in. And a lot of people want to access it, but it's just so hard to get into. So I think there's a large swath of people who want to be investing in real estate, but finding that point of entry is really difficult. And with Arrived, our fractional model, you can start investing in residential real estate for as low as $100 per investment. So each share is $10 when we're making the initial offering, and you buy 10 shares as a minimum amount. So that $100 entry point allows you to invest in rental homes, vacation rentals, and even our two fund products, which is a single family residential rental fund, and then a private credit fund where we buy really interesting residential loans to support the dividend payments out of the credit fund. So that was a lot. So I'll pause there and take it
Yeah,
away
no, thank
in your
you.
direction.
So
Yeah.
the first thing that I'd like to dive in a little more on is some of the things that you all have accomplished to date. What I'd like to understand is, how many homes have you invested in? How much, capital has been raised on the platform from your investor base of individuals? Have you been able to provide any returns? Just trying to make this real for folks. Like you guys have been around for a bit now, and you're starting to have a track record. So let's talk about that a bit.
Yeah. So to date, we've invested in about 450 homes. About 400 of those are long-term rentals across 50 plus markets. And then the others are vacation rentals in a smaller concentration markets. We have raised about $170 million of funds, of investor dollars coming in. And we try to make the experience as close as possible to earning or to entrepreneurially investing in your own real estate. So kind of the way that works is we spin up an LLC. That LLC holds title to the property. And then those LLCs are what we qualify with the Security Exchange Commission to be able to sell the shares, the equity in that investment vehicle as kind of a pass-through way to earn the economics of that property. So for dividends, we've been historically paying out about a 4% dividend, just large portfolio averages on our properties. And those start a couple months after the initial offering is made. So we're basically stabilizing the property, getting the tenant in, and then once it starts cash flowing, then that's when the dividends start, as if it was rent coming in. So, we do we're really a sponsor where we find the properties, acquire them, and then manage them for the holding life of that investment thesis. To date, we haven't sold any property yet. So we've been operating for about 3.5 years. We're starting to get to that selling window. Our average time that we expect to hold a property is about 5 to 7 years. Could be shorter, could be longer. They are more guidelines. They're not hard requirements. But the North Star for us is if you can hold it longer and get higher returns, we'll keep holding it. If it makes sense because there was a lot of appreciation to sell it a little bit quicker and get a higher RR, we'll do that as well. But basically, the two components of the returns are the dividends resulting from the rental operations, and then the eventual appreciation accrual of equity that we embed in a share price, because remember, you're buying shares, not being on an actual deed. So on a quarterly basis, we'll update those share prices and it'll track the equity value. And they're estimates, because until you actually attempt to sell your property, it's hard to say what the real value is, but we triangulate with a couple of different data sources that try to give an impartial view, where we're not having our thumbs on the scale of, trying to make it a marketable moment. It's just, all right, this is what the data source providers kind of triangulate on as the value, and we'll use that as the input to revalue the shares on a quarterly basis. We've been giving out pretty good dividends, I think, for a young company, and we have a pretty experienced team on the SFR investing side. But the dividends are real. They get paid out on a monthly basis, and it feels like an experience where, if you own that home yourself, then that cash flow is coming in.
I love that. Obviously, one of the key components of being successful in the real estate investing process is acquiring the right properties at the right time in the right place. So I'd love to just get a little into, if we look at kind of the overall landscape of the United States, what regions are you focused on? Why are you focused on those in terms of seeing growth potential? And then to go one layer deeper, how are you ultimately deciding on the individual acquisitions? How are you finding them and deciding that that's a fair and reasonable price that's going to leave room for appreciation and upside?
Yeah, great question. So generally, we start with the macro and then we go for the micro, right? So we go top down first, saying which markets are we going to invest in? And at the beginning, when we were starting in 2021, it was a wider set of markets. I said that we were in 60 markets, roughly, across our entire portfolio. And a lot of that was prior to 2020, the summer of 2022, we had spread out to all those markets pretty quickly. And then as the interest rate environment changed, where rates were going up, we felt that the buy box was getting tighter and tighter, because we're trying to maintain good dividend yields, and we're trying to have enough upside such that when the market does come back, that it would go on an appreciation run. So in the beginning, we were investing in a lot in the Southeast and kind of the Mountain West time zone. So that would be in Arizona, Utah, Colorado. Was about as far west as we had gone. We hadn't gotten into coastal areas, as we thought that for an SFR investment class, it didn't quite have the right balance of both the rental income generation and the appreciation. Certainly, West Coast has gone on a bull run for the last 30 years in terms of real estate values, but it also puts it in a little bit more of a precarious position of being able to continue to deliver that type of outsized return. But you're taking on a lot of risk from an income perspective when you're buying homes that might be $1 million, but only generating $4,000 in rent per month. So that kind of dislocation was not the balance we were looking for. So we were more looking for lower cost housing that, it's not necessarily like, workforce housing that we're looking for. Our standard products of 4-bedroom, 2.5 bath, 2,000 square foot home built by D.R. Horton, post 2012. So it's very new product. It's very modern housing, but it's at a price range that makes it more affordable for both, that delivers good returns from an income perspective and has room to run up, because the average person can participate in that, as opposed to, really requiring a 3% mortgage rate to buy $1 million home in California, right? So we chose markets, broadly at first, because with low interest rates, there's a lot of opportunities to get into a lot of different markets and play different parts of it. But as affordability concerns come in, then your buy box starts getting more constrained and shrinks. So we're predominantly purchasing in a couple of states in the Southeast today, right? As interest rates got to 7.5% on a 30-year fixed mortgage, we narrowed our box down to trying to be below about $350,000 on purchase price, because we find that the right mix of like rental economics demand for the product is around that $300,000 house that is for a $2,000 rent. That to us is a very like cookie cutter, bread and butter type product that we're looking to get. And we're looking to buy new homes because we want to manage costs over the ownership period. So, we don't want any major structural concerns. So it's nice to have the builder warranty and have up to a 10-year on the structure. We want to minimize any sort of like nickeling and diming of small electrical, components and things that were going to cost you a lot over the long run and start adding up. So we really targeted newer builds, if not new builds. And in fact, about 48% of our purchases have been new construction, not even like newish construction, like literally new construction. We're the first owner of it. So those are the areas that we picked from a macro perspective. And we're also trying to avoid too much saturation. So a lot of the top 40 metros had larger institutional investors in them, like my prior company, American Homes for Rent, Invitation Homes. They're in a lot of the large markets. And it's not to say that we don't invest in those as well, but we put heavier allocations in markets that they haven't tapped into yet, because there is a different model. They go for scale, buying thousands at a time and internally managing their operations. So they didn't start hitting places like Huntsville or Chattanooga, Tennessee, Knoxville, Fayetteville, Arkansas, because there wasn't enough inventory in the 2010s for them to capitalize on to really be part of their game plan. So we think that those are nice areas that have a high quality of life, low cost of living, has to be close enough to an infrastructure. Like we like to see 2 interstate freeways in a metro before we'll even consider investing in there. People got to come in, goods and services have to come in, and it's best done through interstate freeway systems. So that's kind of our macro thesis, that affordability and follow the home builders where the new inventory is, and avoid the institutional competition. We think that just provides the best possible returns for the future outlook. And then your question about how do we do the micro part of it, like how do you actually commit to that home in that neighborhood with that layout at that price? So I described some of it first with our buy box as being 4-bedroom, 2.5 bath, 2,000 square feet. Usually those will shake out around $280,000 to $330,000 new, which is also part of the investment thesis of if you can get that type of asset at that price compared to, say, a resale home where maybe it's on its second owner or it's built in 2008 or 2012 and prices are nearly identical, then we're going to opt for that newer inventory. So that's a big part of how we cut the large swaths of, like we won't consider X, but we'll focus on Y. That's a big part of it. And then it just comes down to the human part of investing, because I think it's both art and science. And the science is we're looking at numbers and we're kind of focusing in on a thesis. And then the human part is when we're seeing a property that's for sale, we'll drag the little human onto the Google map and literally look at the street saying, is this a desirable place to live? Surely the price looks good. We think the rent checks out, but is this somewhere that people are eventually going to pay more money for? Is it going to appreciate? And not every property is like, white picket fence, ideal, Americana. Some of it is path of progress where it looks a little bit rough today, but you see the infrastructure gaining momentum. You see the city commitment to investing dollars in those projects in those neighborhoods, and we'll start investing in some of those places. So basically the economics on the underwriting have to look right with the cash flow. So the most important values, that rental value relative to the purchase price. So it's one of the key heuristics that drives the cap rate or the return on the cash flow, is how many dollars do you have to pay for dollar of rent that you're going to generate? And we're trying to hover around that 150 to 1 ratio, which is a $2,000 monthly rent for a $300,000 property, right? So when you start having those rental economics that produce the higher cash flow, and then they meet your buy box, that's when we start striking. And then it has to look good enough where, it's both desirable to renters and future buyers.
So that's super helpful. Thanks for diving in on that. One of the things that I think is really important for people to understand with these single family rentals is the rental aspect. And I think there's 2 very valuable things that we need to cover, which is one, the individual is essentially paying down the mortgage for you, right? Plus maybe throwing off a little bit of cash flow. And then 2, the role that debt plays in helping your returns to look even better, which is very much kind of the private equity style, right? You're putting 20% in cash and 80% is coming down in debt when you're purchasing these properties. So can you talk about the benefits of, running these homes from a cash flow perspective, from them buying the equity for you and utilizing debt up front to really maximize gains for investors? How all of that works for folks who haven't done this before?
Yeah, definitely. So we're generally supporters of leverage, right? All of that debt to help amplify the returns. And we see it come in 2 ways. So first, on the income part of it, it can help boost yields to the extent that your cap rate, which is basically just cash flow divided by the purchase price that you're in, When that cap rate's in excess of the interest rate that you're paying, you're getting positive leverage on the cash flow. But where the benefit really comes in is on the appreciation component. Because as you only owe the bank whatever you had borrowed at most. So you capture all of that future appreciation. And a really simple example that we say on our webinars to kind of illustrate this point is that if you were to buy a home for $100,000, let's just say you buy it straight in cash, and then 5 years later you sell it for $140,000, you have roughly a 40% gain, right? And let's imagine that same scenario, but you're using leverage now. So you get a $60,000 loan from the bank. So you're putting $40,000 down and you sell it for that same amount 5 years later, 140K. So you have an extra 40K in your pocket after paying back the bank, and you only invested 40K to begin with. So you have 100% return. So instead of a 40, you get 100% gross return. And that, in a nutshell, is why we like the financial leverage on investing in real estate. So we haven't been using mortgages for the last 2 years because they got to rates where we didn't think it was economically advantageous anymore. Once we got past about 6%, we really cooled off the mortgage activity. We lowered the leverage amounts. So we used to lever our properties about 65%. That got ratcheted down to 50% just because the interest costs really started taking away from the economics of the real estate. So we do try to use it pretty responsibly, only to the extent that it's a benefit. You can kind of think of leverage in two different ways. We most commonly think of a mortgage as as kind of a necessity. Most people don't have the cash necessary to put down the full purchase price and then just live more, without any sort of debt. The other way, though, is the first way we were talking about, and going from a 40% return to 100% return on that example house. And that's why we primarily focus on trying to find leverage for those investments. So we're happy that the rate environment is coming back down. It both encourages appreciation over the long run for properties, and then we can amplify that leverage. One note about our programs in kind of how does Arrived use it? We are typically using non-amortizing loans. So these are interest-only loans because we are trying to maximize the amount of leverage that we have outstanding because we're really wanting to capitalize on the appreciation component. So our loans don't amortize. They are interest-only loans. So that's especially why we've also, are sensitive to the interest rate because you're not paying down the debt amount in this case. We're banking on the fact that we're trying to pick the right properties that'll have the appreciation, and then you try to strike on that as soon as you can to get the maximum IRR in a shorter period of time.
When we talk about the property management side of things, you're buying over 400 properties to date across multiple different states. You don't want too much saturation in any one market. Technology can solve a lot of things, but when it comes down to things like property management, right, that is a human body effort to manage taking care of renters in their homes. So how do what does that team look like, and how are you going about the process of efficiently and effectively running kind of the property management capability of this business?
Yeah, great question. So long-term rental property management is very much a game of scale. You need enough doors to really support the full-time employees that you would have to manage it. So because of our kind of scattered nature, we made a very intentional choice to prioritize where we can invest as opposed to being constrained by management. And when I say that, I mean that we're not investing the first 400 homes in one market and then hiring our own full-time employees there. Because if we're wrong about that market thesis, that's a lot of concentration to be wrong on. So we preferred to find the best investments in the metros that we were searching and then opportunistically pick those and then rely on another group to have the economies of scale to efficiently manage it. So that, in a nutshell, is how we deployed our property management program and like how it kind of intersects with our investment philosophy of be opportunistic, pick the right house. Even if a market is not rising on the whole, you will have neighborhoods and homes that are the beneficiaries of just being a high quality home in the right area. So in order to pick those off, we had to trade off on not internalizing our own operations. So we do partner with those third-party managers, but internally we have an asset management layer that really gives the game plan instructions to the property managers. Because the team that we've hired for our investments team, they're all ex-veterans of the American Homes for Rent kind of game plan, as well as just other players from the rental industry. So we definitely know what game plan works, and we give a lot of those detailed instructions to the property managers that make sure that their operations fit with what we're going for. As an example, we default to 2-year leases when the industry norm is one. And basically, we do that because we want to bias towards people who aren't going to move out. It's as simple as that, right? So if you give somebody the chance to nest in a property, orient their life around that location and schedule, then higher likelihood that they're going to stay for a longer period of time, and that's what we're going for, especially being in a remote managed context. So I describe it as like the investor gets two sets of eyes on the property. One is the PM who's actually executing the ground game and putting the signs in the yard and then following up with the tenants. The other is the asset manager who knows the property manager game and can be an extra oversight layer on top of that property manager, which is, also the enforcement mechanism to make sure that your property manager is doing what they should be doing according to whatever plan. So that's a little detail on how we're structured, and like the why, because we wanted to prioritize selecting the best investments as opposed to having the most efficient operation. An American Homes for Rent that has 3,000 properties in Dallas, they're going to have a lower operating expense than us. It just is necessarily the case with scale. But if Dallas slows down and they have acquisition teams there, they still have a salary role that they need to, salaries that they need to keep paying out for maybe zero acquisition activity. So, being able to turn on and turn off markets is a critical component to how we make good investments, no matter what the cycle is. We were very easily able to pare down the number of markets we invested in as a mortgage went from about 4% to 7.5% in 9 months. So, it's paid off in these volatile times for us to structure ourselves this way. And then as we grow the portfolio over time, we can start incorporating elements of scale into that managed game plan, because there will be markets where we have more density than others. But until we get to that point, we like having that flexibility of being able to be a stock picker more or less in those markets, except we're picking homes instead of stocks.
Now, one thing I do want to mention, everyone, feel free to drop your questions in the Q&A section or in the chat section, preferably the Q&A. That we'll make sure to get to those at the end. But want to keep going here. Many people have probably heard about, the BlackRocks of the world creating these massive, private funds, and they're buying up billions of dollars worth of home. I think a couple $1 billion worth of, single family homes, and they're doing these rentals and whatnot, because they recognize the extreme value of the American housing asset class. When you have massive players like that, an easy question that could come up is, how are you guys getting, the premium kind of housing? How does it compare to these big institutions? How does someone like you compete? I'm just a guy putting in $100. Am I really getting the same level of quality that those folks would get? Would love to hear your thoughts on that topic.
Yeah, for sure. And there's a lot of great companies out there. So I would first say that the BlackRocks of the world and the American Homes for Rent, they actually provide a really valuable service in the market. They provide good professional housing. It's much cheaper to rent than to buy right now. So a lot of people are seeking rentals. And I think the American dream is shifting a little bit. So first, I just want to say that it's a good force to have in the market to provide this serving, and to provide this service that they do. And it was probably most apparent during the Great Recession, when you had a lot of neighborhoods that were just decimated. So they were abandoned. There were a lot of foreclosures, and kind of a rundown neighborhood only attracts more kind of bad activity. So when those institutions came in, bought up a lot of the homes and had capital to invest into them, it kind of served as that gravitational force to repair things. It was definitely a good force to have in the markets. So I think that when you look at the size of the U.S. residential housing market, it's over a $30 trillion market. It's the single largest asset class in the world. If you constrain it by asset class and country, there's no single bigger asset class than U.S. residential real estate. So the institutions that we speak of, like the BlackRocks of the world, they own something like 3 to 5% of that total inventory. So by and large, it's still, it's a little bit more than a drop in the bucket. I don't want to try to marginalize how, because concentration is not uniform either. If you go to a place like Atlanta, I think about 10% of the inventory is owned by institutions. So it's not spread out evenly. And they certainly have, an impact on the market. It does. Like, I won't sit here and say that, oh, it doesn't affect the housing markets at all. It does, because any additional competitive force in the market is going to drive up price because they're an additional lever for demand. But with that said, how do we compete with them? Part of the strategy is avoiding them. We're not going to put too heavy concentrations into where everyone else is, because then you start becoming a price taker. It's commoditized a little bit as far as the returns, the product, the offering. Everything starts getting a little bit more uniform the more competition that you have. So that is why we also have invested in markets like the ones I described earlier in Tennessee, in Arkansas, in the Carolinas, that the institutions haven't quite gotten to yet. So a lot of builders are going there. They're a great proxy to understanding where population movement is occurring. So we kind of followed that builder game plan and look for the affordability. So I think that, like, it's, if we were to try to collide head on with them, that's not really our game plan, to try to directly compete with them. We are trying to find really great investments all over the country. There's 50 states, and there's plenty of unexplored territory. And there's, the other 95% of the market that they're not participating in. So I think that we take a lot of learnings and elements from their game plan and deploy it in a slightly modified way that focuses more on the investment component, that the purchase and the sale, as opposed to the 30-year operating plan that they may have by, investing in 5,000 homes in a market. Invitation Homes, they had at one point close to 100,000. I think they've paired their portfolio where they're more around the 80 to 90,000 range, but I think they only operate in about 7 or 8 states. Right. So that's like heavy concentration in a couple of markets, and there's plenty to invest in that's not directly competing with them.
What is your kind of compensation structure for Arrived? How do you guys make money? I know a lot of people ask that question to understand how that might affect their returns.
Yep. Yes. So we have a pretty simple model that really has two primary types of fees. The first one is a sourcing fee, and that's 3.5% of the purchase price. So that represents the full world of real estate investments. What could you buy? Underwriting a lot of it and paring it down to the investments that we have conviction in. And then you go through the contracting process, due diligence. Just about every time Arrived is fronting the capital necessary to purchase the property, just because we also have to then qualify the investments through the SEC, get them ready, get them leased. And by the time all of that happens, then investor money is coming in and taking out Arrived's position. So all of that is the sourcing fee. So on a $100,000 property, there would be an extra 3.5% charge on top of that. But we do pass through the purchase price of the property. So even if we get a great deal, that means the investors are getting the same deal that we got plus 3.5% on the sourcing fee. And then for management, it depends on the product, but roughly you could proxy it at about 1% of the equity value of it per year as a cost. And it's fixed. So on a levered property, you're going to have a cheaper, effective cost because there's less equity available. But just basically proxy it as 1% of the basis of the asset. So on that $100,000, then it would be $1,000 extra per year for facilitating the whole game plan. And those extra elements involved can be bucketed into two groups. One is administrative and financial, and the other one is economic, like substantively, how do you generate more cash flow? How do you work with the PMs? What decisions do we make on the actual assets themselves? And then there's a ton of admin work going into the structure necessary to support the whole share model of the fractional investing program. So we spin up LLCs for every single one of these properties that we're offering. We audit properties twice a year, so you have unbiased financial statements to refer to. We pay out dividends on a monthly basis. We send out tax statements at the end of the year. And this might be particularly interesting for your investor group. Well, part of the magic of Arrived is that we found a way to consolidate all the financial statements of different investments into a consolidated 1099 div. So whether you own one property or all 400 of the long-term rental individual properties, you're going to get one 1099 div statement at the end of the year that takes like 5 minutes to fill out because there's really only three numbers on that thing. It's the cash flow you receive, the amount attributable to ordinary income, and then the repayment of principal. So you fill out those, and then you're done with taxes with Arrived for the year. The alternative would look like having 400 K1s to incorporate into your tax return. And that would be a non-starter. Because if we issued K1s, yeah, maybe you invest in one or two and, it's fine to add a K1 to your tax return, but, they take like 15, 20 minutes and it can be more substantial to fill out. So you have a couple, okay, fine. You have hundreds, nobody's going to invest in multiple properties and Arrived. So that was kind of the magic of like how we figured out how to have an investment structure where you could consolidate for taxes. But anyway, kind of diverging from the point about fees, but that's also part of the 1% management fee that we charge on the annual basis is to do all that. You have state and federal tax returns. You've got the monthly distributions, the 1099 divs. So a lot of that financial administration makes it very easy to invest on Arrived. And it's a very practical consideration because the first time you fill out your first K1, you're like, ooh, okay, having too many of these is not a good thing. And that would probably prevent people from investing. So we had to find our way around that. And fortunately, we did.
That's great. I can say one of the early platforms, and I won't mention them by name, but I ended up with about 20 K1s, and it was a disaster. And they were all for like 3 pennies, which was fairly annoying as well. One more question for you here before we open it up to some crowd questions that have already been coming in. When you think about Arrived, I think 5 years is a hard projection, but 2 to 3 years down the road, how many properties are under management? Do you have new fund products? Kind of what does it look like? How do you continue to evolve the business forward for investors?
Yeah. So before we get to volumes and kind of the expected investment volume, I would say that what we're really focused on is single family residential investing. And, we usually think about long-term rentals when we mention the asset class, but there's also vacation rentals, right? So it's a different slice of the segment where we're buying homes that are more like 800,000 to $1 million, and then really creating awesome experiences out of it that generate $100,000 plus in gross bookings per year. So it's a nice utilization of that slice of the market where if we find a good deal on a bigger home, especially when interest rates are high, then we can create a better opportunity to monetize that with a vacation rental. So our core competency is really focusing on all aspects of that residential SFR. And that includes both equity and debt components. Because I think that debt investing can be a really profitable segment. It can be more passive and it can generate really good income returns. But it's not something that is always available to people. Whether you're accredited or non-accredited, it's just harder to get into debt offerings, and it's less common for people to invest in. It's much the game plan that people are more familiar with is buy a rental home, right? Kind of you use debt as a component, but you're not investing in the debt. You're the debtor, not the creditor in most situations. So being on the credit side is also a really nice unlock that we've been investing in for the last 6 months or so. So I would say that 2 to 3 years into the future, even 5 years into the future, we'll continue to develop the competencies around single family residential investings and increase the product offerings such that they're really oriented around that asset class. But we have different, investment products, like a 1031 exchange product could be, a nice way for people to start investing in or leveraging our residential competencies, but not necessarily investing in like a fractional share product. They could be, selling their rental home and then we manage their next rental home. But, a very common pattern would be sell the home in California and use those funds to buy 3 homes in Georgia, for example. We've been contemplating opening up our platform to that type of structure. So as far as growth goes, we've entered a lot of markets that we have a lot of conviction in, but I do think that as interest rates come down, more of the market will open up for us to invest. So we do anticipate market expansion. And that's always going to be a part of what we're looking for. I would say that we would probably have more fund products going forward with kind of variations of operating plans. So you could imagine like medium-term rentals for, say, the traveling nurse. But it's all going to depend on what is the opportunity to purchase the real estate, because you're making your profit upon the buy, as the old saying goes. We've been growing at about 25 to 50% per year, just in terms of investment volume. But we feel like we're still in the first inning. We're the first couple years are really spent um, getting the securities offering process uh, very smooth. And we've gotten that down to about on a weekly basis, we're able to have new investment offerings and qualify them with the SEC. So that's actually a really big part of being able to scale the game plan is working with the SEC and figuring out, what are their key issues, what are they really looking at, and how do we fit volume into that equation.
Mm.
The product resonates, people love it. We've sold out properties in a matter of minutes before. So there's no shortage of demand, but getting routine qualified supply is part of the challenge in working with the SEC. So as we get better at that, we think we'll be able to invest more into, say, marketing and channel distribution efforts. Because until like, there's no sense in landing a big partner and then being stopped by the SEC saying like you can't have this volume of offerings, or so we have to incrementally do it. So I do think that like there's plenty of exponential growth curve to hit still. So I would hope that as we have more of those unlocks, that 25 to 50% per year number starts looking more like 2x, 3x, 5x on those numbers. But that is one of the main unlocks that need to occur, is like it's kind of a chicken or egg problem, is that you have to solve the regulatory side before you really invest into the marketing and distribution side. And that's kind of where we're at right now, of like, we feel like we're really making progress with the SEC and getting an understanding of their key issues. And then as that happens, you have more confidence to throw more money into marketing.
I love that. Well, first off, I just want to say I really give you guys a lot of credit and appreciate what you're building. I know this isn't easy to do. You're trying to work through the regulatory frameworks, figure out how to make this possible and accessible to the general public. And I think it's so, so important that we make this asset class more accessible. So I really do have just a lot of respect for what you guys have built, and I think you're doing a really terrific job. Um, so we have a whole bunch of questions that have been coming in, and I want to start getting to some of them before the top of the hour hits. First question, do I have to be accredited to invest on your platform?
So you can be accredited, but you don't have to be. And in fact, most of our investors are non-accredited. And that's really kind of the essence of the business idea at Arrived, is that it's so investing in kind of Reg D stuff and exotic investments, that's always been available to people who are accredited. But with Arrived, we wanted to make that more accessible. At this point, it's kind of a trite phrase, but democratizing that asset class it was the real goal. So it is open to non-accredited investors, and the minimum is $100 per investment, 10 shares. So we're making it accessible, even if you are accredited, to fractionalize and diversify your holdings, because you could be accredited, but you may only have $2,000 to allocate to real estate. Let's just say that that's the amount you wanted to do. Not enough to buy a house, not enough to buy a note, but enough to buy, $100 of 20 different investments on Arrive. So you could still get a pretty diversified portfolio with any sort of allocation, independent of how much you want to invest.
Awesome. And I did drop a link to arrive.com. We're going to follow up with all the links and make sure we communicate with you. But if you want to go check it out, I do highly recommend you go check out the site to start getting a feel for what it all looks like. I love this question. How do you see yourself compared to other real estate investing platforms like Fundrise or Ground Floor?
Yeah, great question. So with Fundrise and Ground Floor, those are also accessible to non-accredited investors. So that's one of the first kind of dimensions that we can look at as far as who can even invest. And the peers that you mentioned, they're good questions because they are peers in the non-accredited space. So first, Fundrise, I think that they are kind of the patriarch, the legacy patriarch of the non-accredited investment plan with real estate. They were one of the very first companies to offer these types of investments to non-accredited investors. So we give a lot of credit to them for kind of pioneering that space. Where I would say that we're different is kind of the DNA of what we're building versus where they started with. So as their name implies, Fundrise, they're really focused on funds. And they started with, I think, more commercial opportunities, right? So you could invest in buildings, in some of their larger projects, and those are all great, right? Where we really started was a smaller atomic unit of the individual property. So fundamental to that product, as we were ideating on product market fit, we knew that people, like an individual home, resonated with people. Why is Zillow such a popular platform? I mean, you're basically just scouring your neighborhood and looking at pictures of other people's homes. And it's a fun thing to do, right? And that captures our attention. So we wanted both the economics as well as the shopping and investing experience to be oriented around that single home. So there's a big difference between coordinating the effort of individual homes as individual investments as to one investment product that has many, many homes. So we offer both, but the atomic unit of what we wanted to have competencies in was that single home. So I think that's where we really diverge away from Fundrise as an investment platform. And then second, as I mentioned earlier, our real core focus is on single family residential. I think Fundrise, they have some SFR products, and they've been developing some more lately. It's still kind of in that fund context. But if you want to invest in individual homes, whether it's vacation rentals or long-term rentals, we have that small atomic unit and are focused on SFR. So not to take anything away from Fundrise, just some differences, but that is how we are different than them at a high level. Ground Floor, another great company, they really focused on the credit components of this. So they're making loans to flippers or real estate developers or people that need bridge financing, and then they're fractionalizing those loans on their platform, much in the way that we fractionalize ours. So they have individual loans, and we have a loan fund. So that is one difference, that we're not selling individual loans like Ground Floor has the ability to. We are aggregating them into a fund product to provide stable income. But again, another great company that we actually do work with them. So would recommend both companies for debt offerings. But yeah, Ground Floor is also one of the very early players in the non-accredited space as well. So, nothing but good things to say about them, but they're really focused on debt within the residential class.
Awesome. Yeah, no, as far as I'm concerned, you guys really are the equity investment platform for single family rental homes, which I think is really unique and a very valuable thing to do. And agree, I'm a user of all of those platforms as well. A few great questions here. Is your leverage on each asset or on a portfolio of assets?
So leverage is on each asset itself. So we have different loan programs. Again, we haven't done them in about 2 years because of economic reasons. But when we did have mortgages, it was a purchase money mortgage where we would be closing the property with that mortgage. I will say that for all the properties that don't have mortgages on them, we have a term within our security offering that allows us to take out leverage. We call it a strategic refi. So as rates become more favorable, we could have the option of taking out the mortgage, distributing those funds to the investors, and then from that point forward, it would be a levered investment. And the nice thing about that is that we get some we get some results bias in that, and we can choose to put the mortgages on properties that are performing well, that have seen that appreciation. And then for the properties that haven't, then we can choose to keep it off because it wouldn't benefit from it. I think rates have to drop significantly more before we wholesale start putting mortgages on every property. But that's how it's worked to date. And I think that as rates do come down, we would also be looking towards fund level leverage within those specific investment products. So within the SFR fund itself, it's got 46 properties. So we could take out a loan to give it some modest leverage, maybe 20%, 30% or so on the total value. And then it would be that portfolio leverage on that fund product. But the individual ones, they're not cross collateralized with anything else because they're separate LLCs with separate ownership and cap tables. So you can't really put them in the same pool of loans. So they're secured individually.
Got it. What is your typical property management fee as a percent of monthly rent?
Yep. So it'll kind of depend on the purchase price and the debt and the product, but let's go through kind of a bread and butter example. So if you have a 300,000, sorry, property management fee. I was imagining asset management. So property management is 8% of total rent.
Rent.
Pretty
Got it.
industry standard, but we do negotiate some benefits like lower leasing fees and lower construction markup on property improvements. So I think that like 8% is not anything too different than market rate, but in terms of service, collaboration with the partners where, because we're a larger customer with our property managers, we basically have weekly meetings with them to go over the full portfolio. So you do get a little bit more white glove service and you get reduced fees on other things, but the headline rate is 8% on the monthly rents themselves.
Got it. And next question here, we'll take a step back. Does the investment fit into a 1031 exchange structure? I know you hit on that before. For those who don't know, can you explain what a 1031 exchange structure is?
Yeah, this is a great question. So a 1031 investment structure is where you can make a like-kind exchange from one asset to another and defer the capital gains. So if you had an old rental home and you sold it and you have a $100,000 capital gain, normally you would owe your 15% or 25%, depending on your income level, of that on taxes. Now, if you 1031 into another investment, you basically have 45 days to identify the next one, and then I think 90 days to close it, such that you can roll your basis into that next investment and then not have to pay the cap gains of that 100K. So you just, port your basis over to the next investment and then get to keep deferring it until you exit that one. And then predictably, so you might 1031 that next one and then 1031 the one after that. But you can kind of get that merry-go-round of tax deferral until you ultimately put it in a trust. Your heirs get it, stepped up basis, and then you avoid taxes overall. But that's what the 1031 is. Okay, so we don't have that available, and here's why. When you're selling your own rental home, you may own it in an LLC or your own individual name, but you have the title to a property. When you're making an investment on Arrived, you're investing in a security. So it's a share, just like you would buy a share of Apple stock or Amazon. It is a share. So property in exchange for shares is not considered like kind, even though the underlying assets that that LLC holds is a property. So we're looking at ways to mitigate this. There's ways that you can with a 721 UPREIT. So it's a Section 721 exchange where basically you're exchanging a property, you're contributing it to a partnership pool, and then you're getting membership interest in that partnership where you're getting distributions. Now, the difference is that that property that you're selling becomes part of the pool. So you're still kind of attached to it, but you're diversified out of it because everyone else who contributed their property kind of mutually diversify each other. So that is a way to exchange an asset for a security interest that gets you some diversification and allows you to defer the gains. But a strict 1031 in the traditional sense is not currently available unless you were to get into another property, which is what we're playing with now, as far as, hey, you sold your property, you want to come on to Arrive to leverage our team and our platform. Maybe you could take one of the properties in our pipeline or a property that's already rented and exchange that way, because we can essentially sell the property to you then at that point, and then that would be qualified for a 1031. So a couple of options that we're playing with, but currently the traditional 1031 is not available on Arrived.
Understood. Question here about self-directed IRAs. Can you use them? And if so, how would you go about the process?
Yep. So you can use a self-directed IRA on Arrived. We have some great FAQs on our site to do it, but basically you would just sign up with your IRA provider. We have one that we work with called Rocket Dollar that has an integration to our platform, so you'd be able to manage through that. But any self-directed IRA should work as far as putting those the Arrived securities into it. I'm not any kind of IRA expert but we do have those resources on our website in the FAQ section of how to get started with it.
Terrific. Last question we'll take, and then we'll wrap here. Have you raised the investor capital? How have you raised the investor capital to date? And do you have institutional investors or just high net worth?
Yep. So as far as investor capital, we are a venture-backed company. So we've done 2 rounds, a seed round and then a Series A. So we've raised, we actually also did a WeFunder raise as well. I think I've seen on Kingscrowd, you guys have some various WeFunder investments available as well. So we've raised that capital, as well as having some debt facilities that we leverage for inventory financing. So we also raised some of our own short-term notes from our own investor pool to be able to provide that financing for acquiring the properties prior to other investors investing in the equity. So yeah, primarily venture-backed funding. our own debt facilities, and just basically the investors who are investing in the properties. So to minimize the amount of capital that our business requires, we try to shorten the amount of time from the layout of cash, to purchase the property to getting paid back from our investors. So a lot of that is, we'll need less and less capital the quicker we can affect that transaction. So that's also another part of what we're working on to minimize capital requirements for the business.
Terrific. Well, before we wrap here, would love to just kind of give you the last word. Where should people go? What can they do to get started on Arrived? And is there anything else you want folks to know?
Yeah. So really appreciate everybody's time and attendance and really great questions. As far as getting started with Arrived, you can go to arrived.com and then set up an account there. It takes less than 4 minutes. There's 2 pieces of information that are required that are more sensitive in nature, but any investment platform is going to require it. So the first one is some sort of taxpayer identification number to perform Know Your Customer KYC verification, and the other is connecting a bank account via Plaid to start funding your account to make investments. We don't store any of that type of information. It's all passed through to security providers and integration platforms that are like really specialized in protecting that information. But other than that, the account creation process is super easy. And then you can start investing in individual offerings in fund products. And then most recently, I've got the product page behind me, the 8.1% annualized dividend for our credit fund. So encourage you to check out all of the offerings there. And then we also host webinars twice a week on Tuesdays and Fridays for people to attend to learn more.
Terrific. Well, Cameron, thank you so much for your time today. Thank you to everyone for attending. We hope you found it informative and helpful in your investing journey, and we hope to see you on future webinars. Have a wonderful day, everyone.